Hi, welcome to class number 9 of my course in Law and Finance. This is actually the last class already. Today on the program is a really exciting topic, Fintech, blockchain, and the law. And in the second part, in the Zoom session, we're going to read a text by Vlad Zamfir, one of the pioneers of cryptographic coding and of Fintech and blockchain technology applied to finance, which I suppose is quite challenging and takes up lots of the issues that we saw in previous courses, but puts them in a context of Fintech and blockchain law. So let's get started. First of all, what's the reason why the entire financial industry has moved into blockchain technology and fintech in general? What's the background of this development? Well, I suppose there is a number of factors. One factor might be mistrust in the banking industry. That is a consequence of the financial crisis. The financial crisis revealed it to many people that the banking system may not be as secure as they may have thought. And many people still sense that the banking system, at least in some countries, bears considerable risks. So they better want to put their money in a safer place. A second reason might be low bank profitability. So the banking sector or the financial sector is looking for new ways of becoming profitable. And one way of becoming profitable again is to innovate. What are the reasons why the banking sector is so profitable? Well, in the aftermath of the financial crisis, regulatory requirements were raised. So banks now need more capital for whichever credit they extend, even it's not overly much, but those capital requirements rose. Another reason is low interest rates. We've lived in a low interest rate environment and it's not going to change anytime soon. That is because low interest rates have a number of reasons. That would probably be a topic for another day, but I suppose it would be short-sighted to simply attribute low interest rates to central bank policies following the financial crisis. Of course, central banks have been lending freely. It's a topic we've raised several times in this course, but that's not the only reason. So it's not just to, safeguard states and safeguard the financial industry. There are other factors like an aging or in some cases even shrinking population in the developed world, which puts a limit on your growth expectations, and growth expectations are always a factor for high interest rates. And if growth expectations are low, then interest rates are supposed or are expected to remain low as well. Another factor are lower capital investments. So it costs comparatively less to innovate in the industry. You don't have to buy huge machines. You sometimes only have to buy a computer and to find a good software engineer who develops the tool you need. And then you're fine. And then you can generate a business at a low cost. But that means that there's not so much need for funding. Again, a factor that contributes to low interest rates. Anyway, so and all of that really has an impact on the profitability of the banking industry. And so many people, like at established institutions, but also newcomers, are trying to make something or to gain some profit from moving into digital technologies. And that, I think, is part of a general societal movement, that digitalization is just the way to go and a way to make profits. Now let me be clear what I talk about when I speak about fintech here. Fintech is way more than Bitcoin. I think that Bitcoin is the proverbial tip of the iceberg only. Fintech comprises a host of new services, intermediaries, and instruments. What services do I have in mind? Well, just think about the ways in which payments have changed. If you can remember, try to think back 10 years. I don't think that we had PayPal at that time. I don't think we had contactless payments. I don't think we had something like Apple Pay and you name it. And of course, the whole digitalization of the economy in general has also boosted payment services. Another factor are credit scores. for example, for consumer credits. That's become an important service for many credit providers, whether it's credit cards or various online services where you can get some credit at least for a certain time, and then they might want to know more about their customers, so they rely on credit scores. And those credit scores are comprised of various data which banks and financial institutions or service providers can find in various sources, and then they feed all that information into their machine, into an algorithm, and then the algorithm decides whether you get a credit or not. That's a very simple model. It's really a field of its own, but it's a very important service. Another type of service is so-called Robo Advice. So it seems kind of intuitive that a computer, and especially a computer equipped with artificial intelligence, can make better investment decisions just because they can process a lot more information, and a lot more coherently so, without all the biases that you barely can escape when human minds make decisions. So a lot of new innovative technological services have developed that on the whole very often relate to other digital services. So this is really part of the digitalization of the economy. And let's also not forget about smart contracts. Smart contracts are kind of automatic transactions. For example, your coffee machine likes coffee, then it sends a signal to a coffee provider, and the coffee provider orders or puts an order on its way in the moment when the blockchain on which it is normally based makes a transaction, and so that you pay the service provider. So it's basically an automatic transaction of goods or services plus payments in exchange for them. A second type of fintech applications includes intermediaries. So fintech is very popular for platforms on which you can trade all sorts of stuff, especially financial instruments. Well, think about all these online trading platforms like eToro, for example. On some of them you trade in real securities or in real cryptocurrencies. Very often, the electronic platform also deals with electronic tokens, but that doesn't necessarily have to be the case. You can also trade with other sort of real securities there. And very often they only use contracts for difference, which is kind of a simulated sort of trade. So you don't really get a security, but someone promises to treat you as if you had the security. And all of that is quite dangerous, I would say, because it can make people addicted, but it's not very heavily regulated, at least for the time being. A third type of fintech applications is instruments. Now here we're talking finally about cryptocurrencies, but they're just one type of token. They're so-called payment tokens because they're used for payment transactions. A second type of token are so-called equity or investment or security tokens. They are basically securities, something that you hold for it to appreciate or for it to pay a dividend. It could be, basically an electronic form of a share in a company. And a third type of token are utility tokens. They're not financial in the sense that you hold them for non-financial utilities. They're giving you the right to a financial service. For example, if you hold a token of a company, then you have access to whichever service or whichever goods that company offers to you. Many of these fintech instruments are based on blockchain technology. So therefore, let's take a quick look at how blockchain technology works. I suppose most of you know that. This is just a very simple 101. So a blockchain is really literally that. It's a blockchain. It's a chain of blocks. Now, what's a block? A block is a compilation of transactions of payments, of services, of tokens. And there are different ways how these transactions are carried out. Normally, in case of blockchain, these transactions take place within a network called a distributed ledger technology. So it's a decentralized network where there's no clear center that decides about the validity of transactions, but all the participants in the network decide together in whichever way, very often by consensus, whether a certain transaction is valid. Now, once a transaction has been validated within that network, it becomes part of a block. That's here, for example, block 1 on the left. And then all the transactions that become part of one block, so that's a certain number of transactions, are transformed with a crypto technology, or with a cryptographic technology, into a hash. A hash is a cryptographic function. It's a sequence of numbers that stands for these transactions, but you cannot really read the transactions. So it's anonymous, or at least pseudonymous, because some people with advanced technical skills might still be able to read the transactions, but normally, for a genuine, non-hacker, so to say, it's not possible to read the transactions. So it's a coded way of describing all the transactions comprised in one block. And that block of transactions, or the hash standing for all the transactions of a block, gets added to a hash of the header of the preceding block, like a hash that is indicating what is the preceding block. And so by that way, you make the chain. There's always a small element of the preceding block, the header, the so-called, it's just a part of the previous block, and that helps you to identify the previous block, and then you add the next block in the form of a hash comprising all the transactions. And then comes, the following block, which takes the hash of the header of the preceding block, etc. So that's how the blockchain works, and that's why as the quantity of transaction rises, the blockchain gets longer and longer and longer and longer. So it's an exact representation of all the transactions that took place within this network, with the only exception that you can't really read those transactions. Now, there are huge differences between blockchain-based instruments, even within one group. Take, for example, payment tokens. You could have entirely decentralized networks like Bitcoin, where really all the participants in the network decide about the transactions, and there's no central instance that could by and of itself regulate the entire network. Another example for a much more centralized form of blockchain technology would be Libra. I suppose you might remember the attempt of Facebook to establish its own currency. Now, what is Libra? Libra is different because it has a centralized authority, the so-called Libra Association, that's here in the orange field. And the Libra Association is issuing this cryptocurrency to authorized distributors where consumers can buy them, and the proceeds from these purchases of Libra are then wired back to the Libra Association, and the Libra Association actually invests these proceeds, like the money they received from the consumers, in real securities, for example, in sovereign debt instruments. And that is meant to provide a sort of, a real world backing for this currency in order to generate trust and in order to make it less volatile than, for example, Bitcoin or any other non-asset based cryptocurrency. Now, Libra hasn't seen the light of the day yet, but I suppose that, as we go along, we will see a lot of different new forms emerge, some of them following this example with, real money backing it up, other models just, following a centralized way of organization. And then the value and the volatility of that currency depends on the trust that we put into that centralized authority. Now that we've established how blockchain technology works, let's take a look at the advantages and disadvantages.
What are the chances related to blockchain technology? Now, on the one hand, it can be a very efficient system for carrying out payment transactions. You can do that in real time, or not just payment transactions, any kind of transaction, actually. Also, it can provide a lot of stability. You don't really depend on intermediaries. It's one system that directly carries out the task for which you need, in some cases, a series of intermediaries. Third chance lies in anonymity. Especially people in not so democratic countries might appreciate it that the government has not so many ways of finding out what they pay or what their transactions are about. And these networks can also be organized independent of any political power. They're basically transnational networks. Compared to old-style paper-based transactions, blockchain technology can actually also be efficient from an ecological point of view. And they offer great chances for development for countries which lack a infrastructure necessary for traditional transactions. All you need is internet access in order to participate in one of these blockchain networks. Wherever there are chances, there are usually also some risks. So the first and foremost risk of blockchain technology is of a technical nature. There can be technical bugs. There was a number of scandals already. Probably the most well-known is the DAO scandal. That was an investment token which was hacked, and the hackers disappeared with all the money. So that can happen. Even blockchain technology is not 100% safe. There's no 100% safe technology. Moreover, the decentralized kind of organization can be a problem if you want to implement policies, like who is the responsible person. There is no responsible person. Related is the next disadvantage. Who's governing the system? It's just the code, but who decides about the code? There is no democratic constituency. Moreover, anonymity can also be a disadvantage. For example, it allows for lots of illicit activities. Money laundering, first of all. And as you may know, ecology is a double-edged sword. As efficient as blockchain technology can be in comparison to traditional paper-based techniques, a blockchain transaction involves a lot of accounting depending on how the code is written. But if it is written like Bitcoin, it means that you've got longer and longer and longer chains. And so these chains, to add up to these chains, a new block can involve a lot of computational operations that cost a lot of energy. Ultimately, there are also risks for financial stability. There can be a lot of speculation with blockchain technology, and that can lead to asset crisis. Or if blockchains are used for money, it can affect monetary policy. It can even lead to a monetary crisis. For example, it can render government policy or central bank policy inefficient because people with assets just go into cryptocurrencies and don't hold their assets as state money any longer. And in case of highly volatile cryptocurrencies or crypto instruments, if people buy them on loans, there is a high chance that this will lead to a debt crisis. So there are lots of reasons for regulating cryptocurrencies, and there are different attempts to regulate cryptocurrencies. I've got 3 different types of regulation identified in the following, and the first one is classical regulation, basically regulation by prohibiting certain activities or imposing requirements on certain activities. For example, currency tokens could be regulated by existing legislation like the Payment Services Directive of the European Union. Now here is Article 4, paragraph 25 of the Payment Services Directive, which provides a definition of e-money. And accordingly, electronic money means electronically, including magnetically, stored monetary value as represented by a claim on the issuer, etc. End of quote. Now, if you apply that definition of electronic money to cryptocurrencies, you will probably find that it doesn't cover most of them. Because where is a claim involved in something like Bitcoin. A claim really means a legal claim. You need to have a legal claim on an issuer. And a cryptocurrency like Bitcoin doesn't involve a claim because there is no entity to which this claim could be directed, who could be obliged by such a claim. So this definition doesn't cover many networks based on distributed ledger technology. And that is a problem because then all the regulatory measures applicable to e-money, and which are supposed to make them safe for consumers, etc., don't apply.
That might be different, however, for a centralized and asset-backed stablecoin like Libra, where you've got an association that issues the coin and it's also backed by assets. So there the question is, what is that contract between you, the holder of a Libra coin, and the Libra association? Does it give you the right to a claim? There's a report by EBA, by the European Banking Authority, which sets out all these problems, and it says that some tokens might actually be covered by the payment services directives, others will not be covered by it, and so there is a lack of adequate regulation. Another question arises in relation to investment tokens. Is securities law applicable to them? Well, that depends on the definition of a security. So here it is in Article 4.1 of MiFID II. That's a directive on financial markets of the European Union. Accordingly, securities, or transferable securities as it says here, can be shares in companies. Well, normally cryptocurrencies or crypto tokens aren't shares in companies. They can be shares in companies, but many of them aren't. They can also be bonds, that's letter B, or other forms of debt, but very often they aren't, just because they are not reflective of any real contract. There's just this network that doesn't really give you a claim. It's the same thing again, Or they could be seen like any other securities, giving the right to acquire or sell any such transferable security, or giving rise to a cash settlement. Now, if there is a counterparty to you as a holder of an investment token that is obliged to make certain payments to you, well, then probably we would say that this definition applies. But very often in these decentralized DLT-based networks, that is not the case. So again, here we have the problem that it's very often pretty unclear whether security laws apply, and for example, whether you need a prospectus to issue it and whether there's a liability of the issuer. And so consumers are left in the dark. In this case, there is an ESMA report, a report by the European Securities Markets Authority, that also says, some instruments, some investment tokens might be covered, others might be not, and that is a very unsatisfactory standpoint. Another point that has raised a lot of debate concerning its regulation is monetary laundering. So, of course, if a cryptocurrency is anonymous, it seems like a formidable instrument for some money laundering. And for that reason, the latest revision of the Anti-Money Laundering Directive of the European Union also covers cryptocurrencies. So whoever holds or provides crypto-related services, in this case it's the wallet providers or platforms, needs to follow anti-money laundering provisions like KYC rules. That means know your customer. So in that case, they tried to regulate even decentralized networks by regulating wallets and by regulating platforms. But of course, this is an EU rule. So EU can only regulate wallets or wallet providers or other service providers to the extent that they have control over them. So, and with this, things being electronic, it's of course very easy to move outside the EU. I don't want to give you any tips here, but it's only as good as far as the regulatory reach of the EU is, and it's very easy to escape regulation with all these instruments. And so you basically have to rely on authorities in other jurisdictions to do the same thing, which they may or may not do. Another dispute of that kind arose in relation to trading platforms. So the question was, to what extent are cryptocurrencies covered by German security law, by the so-called Kreditwesengesetz, KWG? In particular, are cryptocurrencies a unit of account? If you provide services related to units of account, that's what it says in regulation, then you need to follow the whole licensing process of German security law, which is backed by a lot of European law. And that became a dispute before the Kammergericht Berlin in 2018. And there's a number of the case which you can look up. And at that time, the Kammergericht said, well, it's not covered. The reason for that position is basically historical. They said that units of account are only those units that are actually in use for comparing prices between goods or services. And we can't say that about Bitcoin, not least because of its high volatility, but that's not the use that has been made of Bitcoin so far. And for that reason, they disapplied the German securities law. Meanwhile, there has been a legislative change, and that also shows how the way of, or the development of classical types of regulation goes. So you have to catch up with regulation every now and then. So everything, basically every regulatory regime has to be adjusted accordingly. And that also means that there are chances, or chances are high, that essential public interests get covered by existing or by new regulation. But it's very hard to make that regulation watertight, just because it's so easy to push around these tokens. It only requires an internet connection, and it's very difficult to control where they go. You can control actors that provide services in your jurisdiction, but you don't know what's happening in another jurisdiction, and there are few effective ways, unless you censor the entire internet, of preventing your citizens from making these deals abroad, whether it's illegal or not. Well, in light of this difficulty, there has been a strategy developed by EU, which consists in providing new forms of regulation that are simply better than the existing unregulated instruments. And that would make for a difference, they think so, because then if you provide a safe regulation, people would rather rely on regulated currencies or tokens or instruments of any kind or services than going to the black market. So the idea is to crush out the informal, unregulated developments or phenomena. There are two noteworthy examples in that regard. One is a EU regulation, a proposed EU regulation on markets and crypto assets from October 2020. It provides legal recognition for distributed ledger technology-based investment and currency tokens. It doesn't talk about utility tokens, but the requirement for a token to get recognition is that it is governed by a central entity, which can serve as an addressee of all this regulation. So it wouldn't cover Bitcoin, for example, but it would cover a lot of other currencies or coins. And the idea is, if they are regulated, then there would be a lot of trust in them. And that is also the idea behind digital central bank currencies. They would be safer, they would be backed up by a state, they would therefore be less volatile. And that's why important central banks like the Federal Reserve and the ECB have come up with proposals and with first ideas how they should maybe create, or how they could create, a digital currency under their existing regulatory frameworks. A second type of regulation is called sandboxes. Sandboxes are just that. They're playing grounds for new actors, new services, new instruments, new intermediaries. And what's the reason behind them? Well, it's a way of experimenting with innovation, with financial innovation, and gain experiences for more long-term regulation. How does that work? Sandboxes provide exceptions to existing regulation, whatever that is, for example, securities law. Normally, they only do so if the market actor profiting from that regime carries out its activity at a small scale. So they want to reduce the impact of that. But if you are a new company that is just beginning, then you will probably have a small scale, and then you get some exceptions. In exchange for these exceptions, the companies falling under this regime need to accept continuous ways or continuous controls by supervisory authorities. So it's a much more communicative, dialogical way of regulation. Many jurisdictions have adopted such kinds of sandboxes, for example, the UK, Luxembourg, Switzerland, and Singapore, and you can see those are already existing financial centers, and they're trying, of course, to attract new innovative business by providing these sandboxes. The EU has also followed suit with a proposal on market infrastructures, on a pilot regime, as they call it, for market infrastructures from October 2020 or September 2020. And it applies to DLT-based platform services, for example, settlement services. When there's a transaction, someone needs to do the settlement and needs to ensure that the security is held in the name of the buyer from the purchaser. And all of that kind of transaction, of secondary transactions that follow the primary transaction, can be done via DLT. And the EU wants to encourage that, and that might generate some economies of scale, and we'll have to see whether the market accepts this. The third and last type of regulation is information. For example, the government might issue warnings because they think that certain tokens are unsafe, and then the expectation is that consumers will stay away. Or regulators might collect information by using artificial intelligence, and that's kind of a first stage in a supervisory or regulatory process, and then they can see what they do with that and then resort to more stringent measures afterwards. How effective is that? Here we've mapped on this scale, we've mapped certain warnings that were issued by a host of regulatory authorities in relation to the Bitcoin hype in 2017, 2018. And there you can see that if important jurisdictions, like for example France in February or South Korea in January 2018, if they issue warnings, then it may well be that it has an impact on the market as a whole. But it really depends a bit on who's issuing the warning. Is it a coordinated effort? And if that is the case, then you actually can see that kind of impact. So we think that warnings are a sort of way of, a quick fix. If you've got a problem, then it takes a while to make regulation. You might have to agree at the international level or at EU level about it. And as long as this is not available, you can operate with these warnings, at least in a preliminary way. It's fast and cheap, but of course it's not precise. It's a bit unpredictable, and it requires coordination. So that means that it doesn't look all too bad after all for the regulation of Bitcoin, and we'll have to see what the long-term consequences are. And that is, of course, a process that I cannot and don't dare to predict. It's probably something for a future course on law and finance. I'd be happy to see you there again, and I would like to thank you very much for your attention.